Investors are abandoning Cathie Wood's well-known ARK Fund, once the largest actively managed ETF, which has now dwindled to around $9 billion. Despite Wood's flagship exchange-traded fund witnessing an over 50% surge this year, investors are seizing this chance to withdraw. Over the past year, they have withdrawn a net amount of $717 million from the ARK Innovation ETF, as per FactSet data. This is a significant shift for a fund that had been steadily attracting investors since it was launched in 2014. With assets under management that were once nearly $30 billion, the fund's size has drastically reduced, primarily due to investment losses. Wood's fund, also known as ARKK, quickly became a favorite among investors after the COVID-19 pandemic hit, thanks to its highly successful investments in unprofitable and disruptive technology firms. In the first quarter of 2021 alone, it saw a massive influx of $6.5 billion when its share price reached its zenith. However, the rapid hike in interest rates by the Federal Reserve, the fastest in decades, brought down the valuations of unprofitable growth companies, typically favored by investors in a low interest rate environment with scant returns on safer investment options like CDs. Despite a 67% plunge in ARKK shares in 2022, most investors either held onto their shares or bought more at the lowered price. Now, analysts predict that many of these investors are likely to permanently exit. According to Matthew Tuttle, CEO of Tuttle Capital Management, which runs an inverse ETF allowing investors to wager against Wood's fund, many investors have experienced massive losses. I think some of those people have said, "I'm never getting back to even, this is probably the best I'm going to do, and it's time to get out." In contrast, Wood argues that the outflows are minuscule compared to the total assets of the fund. She expressed surprise at the level of asset retention since February 2021 and believes the current outflows are more likely from those taking profits rather than from those who have stayed through the prolonged downturn. Despite a recent surge, ARKK shares are trading around 70% below their record high. Even though the S&P 500 has risen 17% this year in anticipation of the Federal Reserve nearing the end of its tightening, it is still down 6.1% from its early 2022 peak. The top 5 holdings of ARKK are Tesla, Coinbase Global, Roku, Zoom Video Communications, and Block. Out of these, only Tesla and Zoom turned a profit last year. With Tesla accounting for 11% of the fund, it has significantly contributed to its growth this year. However, like ARKK, Tesla shares are also considerably below their all-time high. Despite the resurgence of technology stocks this year, the most successful ones have predominantly been mature, profitable companies generating substantial cash, like Microsoft and Amazon.com. Unlike a couple of years ago, investors seem to be less tolerant and patient with companies expected to become profitable only in the distant future. Increased interest rates have raised the opportunity cost of waiting for profitability. According to Aniket Ulal, head of ETF data and analytics at CFRA Research, the sentiment has indeed changed since the ARK funds were performing well. A lot of the stocks the ETF holds won't have big cash flows until way out in the future, and it's a more challenging environment for that with rates expected to be higher for longer. Many investors feel that the ARK brand lost its appeal after the fund's massive drop, a sentiment exacerbated by its failure to benefit from Nvidia's substantial rally. Nvidia, the graphics chip maker fueling the boom in AI technology interest, has been the S&P 500's best performer this year, with its shares tripling. ARKK, unfortunately, sold its entire Nvidia stake in January, missing out on its rally. "The situation isn't as rosy as it once was," said Tuttle. Wood maintains that the negative attention received over the past 2 years has allowed ARK to strengthen its brand identity as an asset manager focused on disruptive innovation. She explained, "I can say that in late 2020 and early 2021, when we could do no wrong and people were flocking to us, I felt uneasy. Now, I feel much more comfortable. We aren't witnessing that kind of behavior anymore. This suggests to me that there's a lot of apprehension out there. And that's typically what sustains a bull market." The withdrawal of funds from ARK is happening while ETF investors seem keen to invest in other funds. According to State Street, June saw the highest equity ETF inflow since October, with active funds attracting $10 billion in June and over $100 billion over the past year. Matthew Bartolini, head of America's research for State Street's ETF business, commented in a research note that investors exhibited a childlike enthusiasm and dived headfirst into the market rally. Since its inception, the ARKK fund has an 11% annualized average return. However, the average ARKK investor has suffered a 21% loss on a dollar-weighted, annualized basis, as per FactSet. Elizabeth Kashner, director of Global Funds Research at FactSet, observed, ARKK shareholders haven't made their purchases wisely. Many bought when the prices were high and have yet to sell. Despite the downward trend, the fund continues to be a lucrative venture for Wood, who owns the majority share in its parent company, ARK Investment Management. Its annual fee of 0.75% is approximately double the average fee for active ETFs. Even though fee revenue has significantly declined from its 2021 peak, ARKK has generated over $20 million in fees this year. According to FactSet analysis, ARK Investment Management currently ranks third in daily revenue from active equity ETFs, out of at least 145 different issuers. The market recovery experienced by many of ARKK's tech-centric holdings surprised many, demonstrating the difficulty of predicting performance. Dana Doria, co-chief investment officer at Envestnet, said, "If you were just considering the interest rates, you wouldn't have expected this remarkable growth rebound at the beginning of the year. It's a classic example of why market forecasting doesn't always work. Who would have guessed that artificial intelligence would experience such a surge and generate such immense interest?"